You do have other measures that you can look at. The Atlanta Fed's wage tracker is one that compares people in the same jobs. You can also look at the employment cost index year over year. That's in the high twos. So I think kind of no matter how you cut it, we're probably not seeing too much. One thing I would say about wage gains, though, productivity gains have been low, around 1% on average. And inflation's been below 2, so if you're looking at nominal wages, you'd only expect something in the upper 2s. So I don't see it as being out of line with what has actually happened. It's just not as cyclical as maybe some people would have expected.
Hey, Jim, we always talk about how crazy it is that, we've been waiting so long for the 10-year to start heading higher. And then everybody says, well, it's tethered to the German Bund, which is, 30 basis points. So it's tethered down there. So how do you know that, this yield curve you're afraid to take on, how do you know that that's not a function of what's going on over in Europe? And it just seems weird to me that the bond market is global, but, inflation is disparate and varied all over the world. So they got this crazy number over there, and we're basing our yield curve on totally different economic conditions that are present in the rest of the world. And once again, you might end up being behind the curve because we're responding to influences from a completely different place. And maybe inflation and other factors really warrant higher rates here.
Joe, I was in the Fed in 2000, 2001. The yield curve was inverted. We poo-pooed it. We got it wrong. Greenspan had it wrong. 2006, one of the first speeches Bernanke gave was on the yield curve. He poo-pooed it. He got it wrong. I do not want to play this game over again. We have to take this signal seriously.
Yeah. So you don't care that we're basing our interest rates on economies that aren't they're multi-speed all around the world, and we're tethered to these low rates, but maybe we shouldn't be.
I appreciate the global argument, but as far as inflation in the U.S., I just don't see much inflation pressure. And the reason you'd want to be preemptive would be to shut down incipient inflation. And the market is not seeing that. I'm not seeing it in the TIPS market. I'm an inflation hawk, but I just don't see that developing. And if it does develop, I think we could react and react appropriately. So I just don't think this is a situation where we have to be preemptive.
Let me see if I can wrap it up in terms of what your outlook is. You think the Fed ought to be done for the year in terms of raising rates?
Yeah, I think, if it was just me, I'd stand pat where we are, and then I'd try to react to data as it comes in. I'd look for inflation or inflation expectations, see if they are moving up. What I like about the TIPS-based measures of inflation expectations is they've already incorporated all this in. They've already thought about the German Bund. They've already thought about the fiscal policy that has come on board. They've already thought about the fast growth. They still don't see much inflation.
But they already may have factored in 2 Fed rate hikes.
No, they are factoring in what they think we're going to do, but they're more dovish. The market is more dovish than the Fed. So they think we're going to be more dovish, and they still don't see very much inflation, even with all of those things going on.
Let me ask you how you react to comments by the President of the United States about Fed policy.
We have a mandate by law, and so we do the best we can to try to hit the mandate. Lots of politicians comment, actually, on monetary policy. We have hearings before Congress. The senators and the congressmen get to comment. It's not unusual historically for presidents to comment. So I think it's, in this day and age, we're probably going to get comments from the White House.